Shoot, I got to do Instagram. I forgot. You entertain people.
That too, so they get to see behind the scenes now, even before the curtain comes up. All right. Greetings, everyone.
Hello, everybody. Happy Tuesday. Thank you for joining us.
Hey, little quiz question here for people, because today we're talking about a little company that's had a good year called Sandisk, and I believe they are memory chips. Today, it is a $208 billion company. So here's the quiz. Who can guess on May 12th, 2025, what the approximate market cap for Sandisk was? Again, this is now about $208 billion. So what do you think it was 1 year ago today? Yeah, I'd be curious to see what people have to think.
Bananas. The answer that you told me ahead of time, it is absolutely bananas what has happened to this stock.
Well, Bruce says 40 billion. You're off by an order of magnitude, Bruce.
Here's what's happened to this stock. This was a $37 stock a year ago. Currently $1,400. Look, it is just unbelievable. What is
Freedom here said 10 billion, and we're still off by a bunch. Now, I will say it's not as small as 100 million. But actually, our closest right here, Ryan Zimmerman, says 3 billion. By my calculations, this was a $6 billion company 1 year ago today. So if you had invested $100,000 in this company, I think you'd have over 3 million right now today.
Not bad. Not bad. Not bad. So that's what we're here to figure out. Is this a flash in the pan? Is this company or trying to figure out, is this company in an earnings boom, or is this actually a sustainable thing? We will figure that out. Now, when it comes to analyzing stocks like this, which are in the semiconductor space, I personally think that these are harder than average to do, because historically these have been cyclical businesses, and analyzing cyclical businesses is just harder.
Yeah, well, especially if they're cyclical and now they're going through a super cycle. And it's like, well, how long will this last? Will it be a year?
Yep.
Will it be a decade? The difference between those two things is pretty huge.
My gut feel is, if you asked me 2 years ago, I would have thought flash in the pan, it was a year or two. I now think it's going to be at least a couple of years, given what we've seen for the demand of AI. I mean, we use AI every day in our business. So we would love to know in the chat, is this a stock that you own?
And if so,
yeah, congratulations. Yeah, congratulations if you do own this stock. This is a stock that I know very, very little about. So the point here in this series is we research stocks that we don't know that are interesting to us from scratch. We do so using Stock Simplifier, our proprietary tool that we have, and there's really 7 steps to researching the stock from scratch. We're going to go through each of those steps in order, and we are going to lean heavily on AI to help us do the analysis. Do we have any shareholders here?
I've thrown up the 2 that said yes. We expect you to, you can send us a check a little bit later if you really appreciate the work we're doing here. But no, pretty much everyone else says no, don't own it.
Okay. Well, the first thing we need to do is pull up a fresh copy of Stock Simplifier. We need to put in the ticker SNDK, I think, SNDK. Yeah, a $211 billion company. All right, so we got to first figure out, well, which phase of the business growth cycle is this company in? And again,
I'm very curious to see.
It's very difficult with companies that have cyclical profits to them, because they often fluctuate between profitability and unprofitability. So would love to know what people think here. If you know this company, which of these phases do you think it's currently in? While you are guessing, I'm going to pull up a prompt here, our business phase analysis prompt. I'm going to open up a fresh copy of Gemini. I'm going to paste it in here. Then I'm going to zoom in. It should ask what ticker. Sandisk, SNDK. And we will see what it says. And I have a feeling this is one that we're going to have to do some analysis on ourselves. We might not agree with it. Okay. This says phase 4, high degree operating leverage phase. So it says here, which means profits, but not capital return.
For what it's worth, it was operating profit negative last year.
Okay.
Like a full fiscal year ago.
Okay. 4.6 billion in operating income. Revenue grew 251%. No capital returns. And that means the forward numbers are the best numbers to use, and we're going on there. All right, so let's double click on what Stoffel just said. If we pull up the financials for a second and we go to operating profit, yeah, look at that. Negative.
I'm surprised at how little data we have on this. Is that right? That it's only been publicly traded? No, that can that be right? That it's only been publicly traded since 22?
There might have been an acquisition or a spin out or something like that that caused it. If you want to do some research on that, look, profitable, unprofitable, hugely profitable. So why is the stock 20x? I'm guessing that this profits 5.3 billion on a trailing 12-month basis. Were wholly unsurprising, but yeah. I would say that phase 4 is probably the most appropriate here, with the huge caveat being that this is a cyclical company and has been cyclically historically, and we need to factor that into the rest of our analysis. That's why we check this first, so we can figure out what type of analysis to do.
Okay, so Sandisk was publicly traded. Then Western Digital acquired them in 2016. And then, boy, do they probably regret this, although maybe there's more to it than that. Western Digital spun out Sandisk. I bet they made a pretty profit from that if they held on to some. But that was just a little over a year ago.
Okay. So the data that we have in there is from the spin out information, and it had its own information.
Exactly.
But it's only been public for the year. All right. Well, they nailed coming public, I guess, at the correct time. All right, great. Next thing we need to ask, what does this company do? What are its products? Who are its customers? Where does it operate? How frequently do customers buy? Can it raise prices? All that good stuff. So we'll start with the prompt, the business analysis prompt. Put that into Gemini. We will have Gemini do the hard work of digging up that information for us, going to the SEC filings, and pulling back what it says. SNDK Sandisk. And
our friend Brandon reminds us that Western Digital isn't hurting very much either. I can look and see how they're
okay. Done. All right. Sandisk from August of 2025 and the most recent 10Q. They successfully separated in February of 2025, reestablishing itself as an independent, publicly traded company. What does it do? It's a global leader in non-volatile memory, NAND technology. They design, manufacture, and sell flash storage solutions, solid state drives that are used everywhere from small consumer electronics to massive artificial intelligence. Brian, let me give you my understanding of solid state drives. There's no moving parts to them. That's a big benefit of flash drives, right?
So it means no heat.
There's nothing that's like spinning. There's no moving parts.
Nothing can break.
They're faster. They're more reliable. There's less breakage to them. The reason you wouldn't use a solid state drive is cost, right? They're just more expensive than the traditional older school ones, but superior technology for sure. All right. How does it make money? The company generates revenue by selling flash-based products across 3 primary markets. As of early 2026, there's been a massive strategic shift towards high-value data center segment. Geez, I wonder if the market liked that move. Edge computing, 3.6
PCs and phones.
Yeah, PCs, smartphones, and automotive systems. Yeah, that's worth pointing. Edge computing is like pushing out where the computing is done as close to the end user as possible. Right. So rather than doing a database and like there being long communication distance, edge computing is getting it as close to the end user as possible. 62% of revenue, 3.66 billion. Okay. Data centers, 25% of revenue, high capacity SSD for cloud providers.
That's why it's up as much as it is.
Growing 233% sequentially. Wow. And then consumer is everything else, 13% of revenue. Who are its customers? Diverse range of customers, individual shoppers to the world's largest tech giants, hyperscalers, Amazon and Google that are building clusters, original equipment manufacturers, HP and Apple, that put memory into laptops, retailers, Best Buy, Amazon, and local consumers where Sandisk branded cards. Where does it operate? It's headquartered in California, but it operates around the world. Most products occur through a massive joint venture with Kioxia, the Flash Ventures. Kioxia?
I'll just let you try.
In Japan. So it has a massive long-term joint venture with this Japanese company, the Flash Venture. Sales are distributed across the Americas, Europe, and Asia, with Asia being a major hub. No surprise there. Most electronics are built in Asia. All right. How often do customers buy? The buying cycle varies significantly by segments. Consumer is transactional, one-time purchase. Yeah, that's the least appealing business to me. Edge follow a 1 to 3 year refresh cycle. However, the data center business, its new business model, multi-year agreements with firm financial commitments to make revenue more predictable and less stop and go. Okay. Now, what did it say up top? That was
25%.
25% of revenue. So this is
but tripling.
But tripling. It'll become the largest. So I'm going to say highly cyclical, moderately cyclical, the least cyclical. So that's the case, for now, if that's the case, I understand why the multiple has expanded. If Wall Street is really excited about the cyclicality getting squeezed out of this business.
Mm-hmm.
Can it raise prices? Yes.
And it currently is.
A 97% sequential increase in revenue driven by higher pricing. Flash memory is a critical component, and demand is currently outpacing significant leverage to increase average selling price. What happens in a recession? Historically, this is cyclical. Consumer spending drops. Edge and consumer businesses go down. The current AI inflection point and move towards a multi-year contract will make the earnings more structurally durable, even if the broader... So they've picked up on a secular tailwind. It's only a quarter of revenue right now, but it promises to make the business more resilient.
So like we were talking, so last week we did Bloom Energy? And I don't know if you remember, but Bloom Energy's fuel cells were primarily used by like hospitals.
Yep.
Right. So they had a product that did pretty well, but then this technology came along that's eating everything. And it just so happened that
it turned out to be a great
in energy. It's pretty much the same thing. Sandisk has been around for a long time. Phones, PCs, blah, 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 blah. But then all of a sudden, data centers need energy. And it's like they're in the right place at the right time.
With the right product.
With the right product.
So for sure. All right. Now that we've read that, red, yellow, green, let's get some voting in here. Red, this is a business that confuses you or you're not all excited about. Yellow, you get it. You at least understand what it does, but you're kind of meh on the business itself. Green, this is a very exciting business to you. You like the business, you like the business model, you like the where the company exists. So let us know in the comments how you would vote this.
I would say that the vast majority of those coming in are green.
Yep.
One yellow, 2 yellows, but mostly green. And I get it. I think it's exciting. I think the demand is there. I think it's pretty easy to understand so far.
Yep.
So I would say green.
If you were to ask me last year, I would have voted red. Personally. Businesses that are hyper cyclical don't interest me, but yellowish green for now. I'll go with the crowd here and say green. If what they just said, if what Google just said is true, meaning that the business becomes less cyclical over time, that is definitely a very exciting development. Yeah, for sure there. Okay. All right. Next, we have that done. So next thing to move on is the company's moat. Does this company have a moat? What is the direction of the moat? How does that work? Now, there are 5 different moat sources: network effect, switching costs, low-cost production, intangible, and counter positioning. There's a current state of the moat, and there is a current moat direction. Give us your guess or your gut feel about this business. If you think it has a moat, what is the current source of the moat? Is it the network effect? Is it switching costs? Is it low cost production? Something intangible? Or is it counter positioning? Put that in the chat. And while that's happening, I'll run this AI prompt here.
Yeah, so this is an interesting one because the low cost production, it doesn't even matter if they've got this pricing power. To me, I'm curious if there are switching costs because I don't know how hard it is to switch your memory chips. The intangibles are what rise to the top for me. We do have one person saying switching costs. The rest so far have said intangibles, and I don't know. Do you call it an intangible moat, having the right product in the right time in the right place during the right mega cycle? I don't know.
I think it's just having the production capacity to take advantage of a super cycle. That's not necessarily a moat, right?
I agree.
This is a key thing that we've learned about moats. A popular product is not a moat. Just because revenue is booming, a popular product is not a moat.
Yep.
So a moat is what can this company do that its competitors can't. My guess would be intangibles, but not much moat at all. Yeah.
And Brandon thinks it might actually be low cost. So I'm curious to see what they have to say here.
All right. So this says narrow, but the moat's widening. Low cost production and switching costs is built on its unique manufacturing scale via the joint venture and a strategic pivot to AI. 97% revenue growth, signaling a powerful widening of its market position. So the joint venture here, I could see giving it low cost production.
Well, okay. So here's the thing. So, and I'm cheating here. So Brian, I've gone over to our not yet released Stock Simplifier 2.0, and it points out that Samsung has a 32% market share, fully vertically integrated. Micron runs its own fabs with no partner to share the output with. Outside of those two, I could see, but I'm just reading off the screen. I don't have deep industry knowledge here.
So what are you saying? This is not a low cost producer?
I'm saying that if it is, it's limited for now. Now, the thing is it doesn't matter as long as demand is much more than supply. It doesn't matter.
Right.
What the mode, let me just say this. Right now, because supply is so much less than demand, it's like we've got a tsunami wave coming in. Mm-hmm. And some people, to use Warren Buffett's terminology, some people are out there swimming naked. They've got no moat. But it doesn't matter because the tsunami is lifting everything up. The reason that we're checking for this moat is that at some point in the future, it might be in 2028, it might be in 2038, supply and demand will even out.
Right.
And the question we're asking is, when that day comes, who's wearing moat clothes and who's not? That's the question.
And the company build a moat in the meantime, because even if you don't give it low cost production, efficient scale or the ability, a distribution network, like a channels that customers can come through to order it, right? That takes time. That takes time to build out. Like competitors can't necessarily rush into this market and build product immediately. So we might be in a period where it might not have a moat, but that isn't going to prevent profits from exploding in the near term. The moat question answers is what happens after the explosion happens and you give enough time for competitors to enter the market. That's when the moat really matters.
Yep.
Right.
Totally.
And if the market sniffs out, oh, this company doesn't have a moat, and you see the other side of the boom, then look out below.
Exactly.
Right. Switching costs is moving away from transactional containers towards enterprise-class SSDs for AI. By securing multi-year agreements, they are locking hyperscalers into their hardware and firmware ecosystem. This creates high technical friction for customers who would have to re-qualify competing drives for mass AI clusters. So there's a qualification process.
Yeah. Let me just be, I'm just going to be a Debbie Downer here and just say that we've already seen Google, Amazon partner with Broadcom to make their own chips. Now they're not for memory. Okay. They're for other things entirely, but it's so that they don't have to rely just on AMD and NVIDIA for their chips. They're still using them, but they're so expensive that they want to create an alternative. I don't have deep industry knowledge to know whether or not that's something that they can partner with someone to do. finding the capacity to manufacture them is another question altogether as well. But these are the questions that I'm asking myself as I'm reading through this.
Right. To me, flash drive, like a flash drive is I can plug in a Samsung, I can plug in a Sandisk, I can plug in any one, and it just works with my computer. Is there some technical reasons why if you go with a Sandisk, switching, I understand that they have these agreements in place, which are multi-year supplier agreements, fantastic, that protects revenue for a bit, but is there actually a technical reason why this can't happen?
Right.
I don't know. And I don't see anything that screams from the AI, definitely.
Right.
Yeah. So and remember, by default, the answer to the is there a moat question by default is no. That's the default thing. You have to have the company prove to you that it has one. So the long-term contracts, excellent. That gives it, revenue visibility, fantastic. They're moving towards multi-years agreement, which are more visibility and stability. So contracts and agreements are great. You could argue that does support a moat, but I wouldn't say that's a moat itself. Let's see intangibles. Formidable patent portfolio remains one of the most recognizable brands. They definitely do have a brand name. I know the name Sandisk.
Yep.
I don't know if that would make me choose their flash drives over another one, because I also know the name Samsung. I also know the name Micron. Performance specifications outweigh brand prestige. The rapid pace of technology change requires constant, heavy R&D to maintain this edge. So lots of money spent on R&D. Top 3 global providers of NAND flash memory solutions. So the moat might be that this is not a monopoly, not an oligopoly. Is it a triopoly when there's 3 big players?
I don't know.
I think it's triopoly.
I think you still call it an oligopoly.
Okay. So that might be quote unquote the moat. Network effects, none. When you buy one, it doesn't drive network effects. Low cost production. They're 20-year joint venture to share the capital expenditures required for semiconductor fabrication. Model provides economies of scale that smaller competitors.
But we're not worried about smaller competitors. So that's meaningless. Like, I want to know what Samsung and Micron and the other memory players are doing. They're the ones you got to worry about more.
Well, I think this is more, so we could just call it low cost production, but there is a moat called efficient scale. We combine them together, right? You could make the argument that the company has efficient scale, but it's efficient scale versus its largest competitors. Like, this definitely
they've got the scale against startups, but I don't think they've got it against the large competitors.
Correct. Absolutely. Or at least none that you give them to. And then counter positioning, not really. The competitors can do the same thing there. Primary risk, technological obsolescence. The NAND industry, billions of annual spending to keep up with the pace. Faces intense competition from Samsung, SK Hynix, and Micron, all of which are vying for the same competitors. Their valuation we'll get into later. Morningstar does give them a narrow moat / stable and narrow mating, but it's widening due to the multi-year contracts. So it's saying the contracts are the things widening the moat. All right. Given all that, red, yellow, green, how would you guys rate this company's moat? Red, there's none, or there's nothing, or the moat is getting weaker. Yellow, the company does appear to have somewhat of a moat. The moat looks stable. Or green, you think that this company does have a moat and or the moat is expanding widely.
Now, for what it's worth, I just went and checked. It said that the rating by Morningstar was based off of what Western Digital's used to be. Morningstar actually just updated it. You're able to get that with fiscal.ai, which, Brian, I think it's worth just mentioning right now. If you go to fiscal.ai, they've got a 25% off sale happening right now, and it ends on Thursday. So as you pull that up right there, this is definitely worth checking out in the next 48 hours.
This is a tool that we use for all of our deep dives and really for everything. And they just announced that you can like connect your broker to it, which is a pretty cool feature. But they have a 25% off sale right now. If you're interested.
But if you click on that research tab, one of the neat things about this is they will even give you Morningstar reports. So I went in there and I checked, and they say it's a no moat rating at the very top there.
No moat.
No moat.
Okay.
See, it's kind of in the middle right there. Economic
Well,
moat, none.
a lot of our viewers seem to be saying exactly what I would do, which to me, I would give this company a very weak moat right now, but I will acknowledge that it's getting stronger as the contracts are coming in.
You've made a very good point too, that in terms of it, if you wanted to see what co-varies with a stock price, it's actually not the width of the moat that co-varies with a stock price.
Mm-hmm.
It's the direction of a moat. So
Mm-hmm.
if a company has a mile wide moat, but it narrows to 3/4 of a mile, the stock is going to go down.
Yep.
And if a company has an inch moat and it widens to 5 inches, the stock is actually going to go up. The direction is actually what matters the most.
I believe that in my bones.
You've
The
convinced
direction
me of
matters
that.
way more than anything else. So, all right, I think yellow makes sense here. All right, time to move on to long-term potential. So
Boy,
there
is
are
it.
and growth. There are two primary ways that a company can grow: get new customers or get existing customers to spend more. So over on fiscal, if you go to the overview tab here, we can see the company's historic growth rate. So 30% over the last 3 years. Yeah, the data is going to be limited since this was a spinoff. But over the next 2 years, revenue is estimated to grow 137%, and earnings are expected to grow 200+% per year. Oh my goodness.
Now, for what's that's worth, that's between 5 and 6xing. 5 and 6.
The consensus is 20 billion, 19 billion in revenue this year, 41 billion in revenue the year after that. Up from 7. Holy cow. That's up from, so this is revenue. Let's just look at revenue for a second.
If you were to go
10, 6, 6, 7, 13, and then 19, and then 40. Oh my goodness.
If you were to go to the estimates, so if you go to analysis and estimates, and then you just go to the bottom, this is one of my favorite things to do. You just scroll down there. When they started estimating what the company would do next year, they started saying, oh, about $9 billion. Now they're estimating 41.
Yeah. Why is the stock price performance? Look at these analyst estimates. They are skyrocketing. So they are struggling to keep up with how good business is going. So this is for 2026. Yeah.
Yeah.
Oh my, and this is for 2027. Yeah, look at that. Oh my goodness. We can probably stop there with the growth analysis, but for the sake of it, let's see how are they going to accomplish that growth? Let's go ahead.
It's going to be everything.
Yeah, I have a feeling it's going to be new. I have a feeling it's going to be.
They can charge more. They're going to have more demand. Those two things are going to combine and multiply.
Yeah, holy growth, Batman is the thing, is what you'd say right now. Okay, sales and marketing moderate.
They don't need
operating
to.
expenses remain disciplined as they're leveraging new distribution channels. Not active. Yep. Geographic expansion strong. Rapid expansion into the data center market. So that's it. Not acquisitions. Pricing power, definitely. We are raising prices since this is becoming the constraint. New products. They successfully launched a next generation enterprise SSD tailored for AI workloads. So their new SSD is specifically catered to AI. All right, if that's the case, there might be some technical reasons why switching actually becomes more challenging.
I think we need to listen to what Bill said. Is we have to compare that to what Samsung, SK Hynix, and Micron are doing.
That is completely fair. Customer retention is a strength for them. They have 42 billion in contracts. And as a reminder, this company did 19 billion in revenue over the trailing 12 months. So twice the annual revenue in backup. So number one is pricing power. Number two is transitioning from commodity consumer flash to high margin enterprise grade storage. So it's a business model transition. customer retention, market expansion, and everything else. I have a feeling I know.
I don't
how
think we need to pull people for this one.
Yeah. I mean, does this company have enormous growth potential? I don't know how you not come away and say over the near term, absolutely.
Yeah. And it's worth, I think Brad and Mark also make a good point. If this sounds all a bit too confusing trying to guess all these things, you can invest in an ETF that focuses on memory, which is an option as well.
We'll check that at the end. Thank you for suggesting that. Okay, this might be a little bit tricky to figure out the key metrics, which is the analysis that we like to do next. We like to go to a couple of key metrics. The metrics that you track for a company do change depending on which phase of the business growth cycle analysis it ends. This company was a money loser last year. Now it's printing cash. So these metrics might be changing so rapidly, they're hard to look at. So let's go ahead and put that in, and we will take a look at them individually. This is the one that AI continues to struggle with the most, is doing key metric analysis. So it should say SNDK. Oh, there it is. It got that right. All right. Revenue growth over the last 3 years. You want this to be over 20%. We already know
we have no doubt
way over 20%. Yeah. Okay. Operating margin. We want to see an operating margin that's positive and rising. We also already know this figure is very positive and it is skyrocketing. Absolutely skyrocketing. Free cash flow margin. This is positive and rising at 14%. I wonder how accurate that is.
Do you want to guess what their operating margin was last quarter?
Last quarter?
Last quarter.
Let's just see. Well, I'm going to guess 30%.
69%.
Wow. Operating profit margin, 69%. That is bananas.
Look at the gross margins. The gross margins went from 22 to 78.
And we're negative.
This is like
this is commodity business.
The only antidote to a disease that's going to kill you. You can name whatever price you want.
But look at this. This is a commodity business here.
Yep.
Look how volatile gross margins were over the last couple of years. Like 10%, 39%, 26%. This is cyclicality. These numbers are bad business. These are outstanding business. Just jaw dropping. And this 69% operating margin is absurd. That is, we are literally making so much money that we are struggling to spend it fast enough.
Yep.
Wow. Okay. So good. Earning versus estimates. That's going to be an interesting one to check. So if we go to estimates and we go to quarterly, we'll start with revenue. So actual $6 billion, $4 billion estimate, $3 billion, $2 billion estimate, beat. So massive beats on revenue. That's going to get the market excited. Finally is earnings per share. $23 earnings per share, a 14 estimate. $6, $3 estimate, a buck. Yeah. Again, it's a completely different business in the last 6 months. Just a completely different business. So we'll go say always exceeds based on what we have. And then ROIC. I bet we're going to see a similar skyrocket.
It's gonna explode.
So you go to financials and we'll turn this down. We'll take a look at ratios. And then we'll look at key metrics and go down to returns on capital. Capital efficiency. Yeah, look at that. Yeah. Horrible business. Everything changed. 40% return on capital. And that's annually. I bet if we look at quarterly, we see an even more granulated view at that. Yeah. 30% return on capital. Wow. So that's definitely positive and exciting. So the numbers just look sensational.
Yeah.
Just sensational. Great. All right, now comes the real test for this company. It's going to be risk analysis and valuation analysis. So
Yeah.
let's.
You know what the tough thing about this risk analysis is? Like if we just go strictly saying execution, there's almost no risk. Like they just have to do what they've been doing, but just pump it out as much as they can. But there is this like greater forces risk.
So it's what so execution risk is, can the company operate and fulfill the orders and continue to do what it's doing, which
Right.
it has a long history of doing.
Yeah, that's
we
low.
both agree that's fairly low risk. What you're talking about is the demand going to be there at this level, and can the company develop a moat fast enough so that when spending eventually slows or turns in the other direction, that this company can protect itself.
Yep. This is one of those videos, Brian, that I bet over the next year or two is going to look like we were way too negative on it.
Could be.
And 5 years from now, when we look back, they might say, "Oh, I get it now."
All right. Concentration risk. No customer was 10% of revenue. However, a single customer was 15% in 2023.
That doesn't matter.
Is increasingly got giant data center now makes up 25% of revenue. So
they're going to have it.
Yeah, it's not a risk right now. It will be in the near term, right? Disruption risk. So this says not a risk is the disruptor aggressively replacing traditional hard drives in data centers with performance enterprise grade SSD. Its 3D and AD technology is currently leading the industry shift towards AI optimization. So right now, this is the disruptor. Good. Outside forces. High exposure to geopolitical trade tensions, tariff policies due to its manufacturing footprint in Japan and global OEM. The business is highly sensitive to the cyclicality of NAND pricing, which management knows as volatile and rapid fluctuations in average selling price. This is a historic risk. What you're betting is that this is not a risk moving forward as the AI business continues to just explode. Competition risk, moderate. Global oligopoly, Samsung, SK, and Micron, which involve intense pricing pressure, rapid technological obsolescence. While margins are currently at record highs due to the AI boom, management warns that competitors' capacity increases could lead to future oversupply. This is management saying,
they have to. Look, it's not a matter of if, but when.
Right.
But if that when is in 5 years, then it could be a feeding frenzy for the next 3.
Right. Yep. Absolutely. So concentration issue is not a factor right now. It's becoming one. Disruption, no. Outside forces, it says red. I'd go yellow personally, given how a need this is. And then competition, the competition actually looks fairly stable to me. Yeah. So their manufacturing scale, their AI property, their backlog are all mitigating factors. All right, red, yellow, green. What do you think is the execution risk for this business? Not including valuation. Valuation's coming next. And again, execution is the management's ability to take advantage of the opportunity in the marketplace that it sees. So turning the story about the business into future numbers. That's execution.
I'm going to go with yellow. We got everything. We got green. We've got yellow to red.
Yeah.
I mean, to me, this is a question of bringing capacity online, trying to build that moat.
Yeah.
Like that's the big thing. The big thing is, let's call the whenever like the day hits where supply and demand start to equalize, the only thing that matters is whether or not they build a moat between now and then.
Absolutely.
That's it.
That's it. I'll go yellow. That seems like where the crowd is. Yeah, to your point, I think the execution risk here is medium low. The execution risk, it's the market demand risk that is the big question mark.
Now let's be clear. It could keep going up and up and up and up
Yep.
for quite some time.
Absolutely. Absolutely. And so could the stock. This company right now has extreme stock momentum and extreme business momentum.
Yep.
Right? How long will that last for? That's what you're betting on. All right. Speaking of that, let's take a look at the valuation. Trailing metrics are going to be useless. Useless. This is a fundamentally different business now than it was 6 months ago. So from a valuation perspective, we are going to take a look at all forward numbers, and we'll judge them on both a absolute and a relative basis. So let's start with forward valuation numbers. Let's start with price to sales. This is a company that's currently trading at 6 times sales. 6 times sales. That's quarterly? I wonder if you do annually, if it's different. About 6 times forward sales. And as a reminder, this is a company with a 69% operating margin. 69% operating margin. So 6 times
it's
sales.
actually not as high as I thought it would be.
I totally agree. I was expecting 20, but that just shows you how much revenue has increased there. Okay, now let's take a look at forward earnings. This is moderately useful because the earnings are so cyclical. 10 times forward earnings. 10 times forward earnings.
10 times forward earnings, huh?
10 times forward earnings. Yeah, 0.7 times last year's earnings. 10 times forward earnings. Now down here, it was down to 1 times forward earnings. All right, this is probably when they came public. So this is more of a factor of the number
being digested.
So your gut reaction might be to scream, that is crazy cheap for a stock that's growing revenue so fast. Crazy cheap. That's the market's way of saying, we don't trust your long-term earnings power, right? The company might be in an earning, it might be way over earning its actual true profit potential. And those might be masked by the demand that it's seeing. So even forward numbers here might not be all that useful. Yeah. Cyclical companies are just hard to value, period. Yep. They're hard to value. Let's take a look at operating cash flow, price to operating cash flow, and price to free cash flow. Price to operating cash flow, 12 times operating cash flow, and then price to free cash flow. Is that the same?
Yeah.
12 times free cash flow.
Well, the joint venture probably helps with that.
If they're splitting that out. Yeah. Okay. Let's take a look at a couple of again, some numbers. So this is a company that did $4 billion in trailing net income. You can
put forward too to see what they're expecting.
Oh yeah. Yeah. That's a good idea. Let me pull that forward. So
look at they go 5 years forward now.
Let's see how far this goes. Okay, this is a company that's expected to do $25 billion in profit in 2027. Their fiscal year
under 10 times that right now.
Yep. So the market cap here is 200 billion.
Color me surprised. This is not outrageously priced.
It looks classically cheap. Classically. Yeah. There are 2 types of bubbles. 2 types of bubbles. One is a price bubble. The valuation gets completely disconnected from the underlying earnings potential of the business. Those are hard to spot, but they're easier to spot by comparison. The second type of bubble is an earnings bubble. The company is way over earning compared to what its true long-term earnings power is. That's when a company is over earning, its valuation multiples look dirt cheap. And you're wondering, Why on earth is this stock so cheap when compared to the company's growth rate? That's the market's way of screaming at you, we don't trust the long-term earnings power of the business. We think the company is over-earning its true potential. So is this company classically cheap if you just look at multiples? I would say yes. I think it's quote unquote cheap. The question is, do you believe in the long-term earning power? That is the entire story here.
Yep.
But with that, what do you guys think of the valuation here? Red, you think it's overvalued. Yellow, it looks fairly valued. Green, it looks cheap. Boy, is this hard to do.
I mean, I can say I feel comfortable saying it's not red.
Yeah.
For me.
Yep. That's fair. Let me show you a company that taught me this lesson that I just said to you the hard way. I don't know if I'm going to be able to pull it up.
I think you can.
Let's see if I can pull it up. Okay. So this is a company called Gilead Sciences. Gilead Sciences right here produced a blockbuster drugs, Sovaldi and Harvoni, that exploded revenue and profits, just exploded it. And the stock went parabolic when those drugs came out. And if you, I hope I can graph profits over that time period. If you looked at profits over that time period, net income, will we be able to see it?
Yep.
If you looked at profits, no, that's not really showing it. Profits, okay, down. Yeah, it's.
Can you pull it back? Yeah.
Oh, I hope I can.
Yeah.
Aha.
There it
yes.
is.
This is the company's This was before these drugs came out. Look what happened to profits after the drugs came out. 3 billion, 12 billion, 18 billion. This is when the stock was skyrocketing. All right. And if you looked at the price to earnings ratio here, the price to earnings ratio was about 6. It was trading about 6 times earnings. This confused me so much because I was like, how could a company growing triple-digit revenue and profits be trading at 6 times earnings? The market was screaming, we don't trust the long-term earning power of the business. What happened next was that drug ended up curing patients. So it was a one-time drug and a whole bunch of competition flooded the market. Look what happened to profits. They shrank back down and they normalized. So if you're like, what's the company's actual earnings power? It was down here. It was probably 3 to 4 billion, but there was a mirage from the company over earning because of this drug launch. So if you bought the stock when profits were here, you were underwater for 9 years, and it took that long to come back. So this taught me the hard way. When you see a valuation price that looks cheap, that is the market's way of screaming at you, we don't believe in your long-term earnings power. So that's to me what I'm seeing with Sandisk today. Looks classically cheap, but that's to me why the stock is trading so cheap. Yeah. Boy, how do you want to call this one? Yellow?
Yeah. That's what we got from most people is yellow.
Yeah.
You know, it is comforting to know that it wasn't quite as, I mean, it's not as bad as I thought it would be. It's not that the multiple is expanding. I think it went from like 4 to 6 recently.
Right.
So most of this is not being driven by multiple expansion. Most of this is being driven by profit and sales expansion.
Right.
I mean, the truth be told, what most of this is being driven by is by Sandisk being able to name whatever price they want for their chips.
Absolutely.
That's what it is.
So we've now scored this business. It's an exciting business with a developing moat, unbelievable near-term growth potential. Its key metrics look sensational. The execution risk here is moderate, and the valuation, which we have hopefully repeatedly saying is incredibly hard to do. At the very least, the valuation does not look insane if the profits are sustainable. What do you guys think of the business overall? Red, pass. This is a company that does not interest me. Yellow, I'll put it on my watch list. Green, this is a company that's very exciting and you're interested in it right now at today's prices. Would love to know how people vote.
My vote depends on what Mark just identified.
Need to
you can
understand.
explain to me what the demand expansion curve is going to look like, then I'll tell you.
Yeah, yellow, watch list. Yeah, green, Tariq. Hey, Tariq. Red. Ooh, some reds. The company makes hard drives. Sometimes they really need hard drives. Sometimes they don't. Looks more of a short-term opportunity than a long run. That is fair. Yeah, I'll agree with this comment here. The real Rocco. This seems to me like a quite good short-term opportunity.
And by short-term, what does that mean to you?
That means if I was to buy this stock, I would pay extremely close attention to every single earnings report. And the thing that I would pay attention more than anything else is the growth rate percentage. The growth rate percentage, not the absolute growth rate, the growth rate percentage. And is that number going up or is that number going down? Because this is a momentum stock. And when you see the momentum behind a company start to go in the other direction, if a company's growing 100% and then 80% and then 50% and then 20%, like you're like, it's still growing. It's great. The market hates that. The market hates that so much. And the market will sell off the stock if it detects that. So that if I was to buy this stock, that's the thing that I would watch like a hawk.
I would even say the thing that would make this, like, I look at this more as how much work do I have to put into it? So I would say that I would need to watch Microsoft, Amazon, Google earnings and what their cloud numbers are. That might actually be the thing that would be the first domino to fall.
Yep.
So, I mean, you got to be willing to put the work in. And that's why I do think that suggestion of a DRAM ETF is worth considering.
Yep. We will take a look at there. All right. A couple other things we want to check. We want to do some sentiment analysis on this company. I have a feeling we're going to know what the sentiment is going to be, but what does Wall Street say to this? What do retail traders say to this? What does the media say about this company? And what has happened over the last year? I have a feeling that the sentiment is going to be like, wow, but let's just double check that with this sentiment analysis. And while we're waiting for that to load, oh, there goes Google. While we're waiting for that to load, I did want to show you this. So this is the new stock simplifier that we have. We've added a brand new analysis here for the management team. You can see that we've done all the same analysis in stock simplifier, but rather than going from click to click to click, screen to screen to screen, and going back and forth, it's now all on one unified page. And now we can take a look at the company's management team. So let's read it over. So the AI says that this is a decent management team. They led the unscheduled spin-off, they secured the extension, and they tripled data center revenue, but operating losses were wide. So they executed the spin-off. The data center revenue is growing. Unconventional background, came from enterprise tech through Cisco. Unusual for a semiconductor CEO, but aligned with the growth strategy. So this is the CEO. He's been at the company for 6 years. He's been the CEO for 1. He owns 0.35% of the stock outstanding, which is about $300 million. And he led the strategic separation. Do employees like working here? We have these cool little flip cards. So the reviews are mixed. And if you flip them over, it'll actually show you the details behind the ratings. So 3.4 stars out of 5, 62% recommending to a friend. Do they beat expectations? Oh, yes, they beat expectations. Is the management team shareholder friendly? Somewhat. No dividends, no buybacks, and mixed free cash flow. And how strong are margins? They're growing very strongly. So the AI says this is a decent management team. I would say it looks okay. and just needs more of a track record.
I'm kind of curious. Can you just go to the next one? I'm curious what it says for risks. Can you give us a peek? What does it say?
Very high. NAND pricing swings, the joint venture, and a history of operating.
I wouldn't worry about that last one.
Of operating losses. So anyway, the Stock Simplifier 2.0 is designed to give you information, and then you make the final call on it. So okay, that prompt should be done. Let's go to this. Oh, by the way, if you want to sign up for Stock Simplifier, the new one, just go to longtermmindset.co/waitlist. Stoffel, if you could share a link to that in the chat. Great. So if you go here and sign up for the waitlist, we will let you know when the new Stock Simplifier is available. It will be launching this month. We do not have an exact date. We're working on a couple little things behind the scenes, final touches before it will be ready. But we have beta users that have been using this for a month, and the reviews we're getting are the best reviews we've had on any product we've ever done. So very excited to get this in your hands. Okay, sentiment analysis. Overall takeaway, it went through a parabolic re-rating from its spinoff. Totally agree. The next catalyst is earnings, which are in July. The $42 billion remaining contracts. Outlook is the business fundamentals are at record high. The stock's 3,800% gain has led to extremely overbought and valuation concerns, despite a reasonable forward PE. Good job, AI, for pointing that out. Analysts are bullish, investors are neutral, and the media is mixed about this. So there is the price target at $2,000. Sorry, my dog's barking.
There's a rabbit outside.
Re-addition to the NASDAQ 100. Forced massive institutional buying. The bulls are excited about the super cycle. The structural de-risking. Yeah, this is a big deal. The backlog and this makes the business less cyclical. To me, that's the most exciting thing that we learned today. And then the valuation. What do the bears say? Parabolic risk against vertical charts, demand pull forward, over reserving for NAND during a shortage, and borrowing future demand, and cyclicality, a peak cycle mirage. Yeah. And cyclicality concerns. Yeah, I would say that all of that is pretty darn accurate there. For me, this would be yellow. I would be concerned about the long term, the business. I'm a buy and hold investor. I still have too many questions in the air about the long term moat of the business. But this company scored way better than I thought it was going to.
Yep, totally agree.
Yeah, this time is different. This time is different. It's very possible. Yep. And what was the ETF we mentioned?
Is DRAM.
DRAM.
I guess I also know, Brian, we're clearly doing a stock that a lot of people are excited about. So I just want to hit home again that sign up for the waitlist if you want to join our waitlist for Stock Simplifier 2.0. And also, Brian's on the site right now, fiscal.ai. They've got that clock at the top. You got 2 days and 11 hours left. They only give 25% off twice a year. So this is one of those 2 times.
So this looks like a new ETF, DRAM.
And what's in
it? It's got all the companies.
Seagate,
Western, Micron, SK Hynix, Samsung. So if you want more of a if you believe in the trend and you just want a diversified way to play it versus betting on a single,
Brian, does that say that it has doubled in the past month?
Yes. This ETF looks like it's a month old.
And it's doubled.
That's in K. What's that? What?
I'm not sure.
Oh, that's what $10,000 grow into. That's what it's to.
Yeah. So it's doubled. I was like, past month.
Yeah, it's doubled. It's doubled in the past month. It looks like a brand new ETF. Anyway, if you want a more diversified basket to play the trend, there's an option that one of our viewers brought up. I have no idea what the expense ratio is or anything like that, but it does look like a diversified way to get into them. Thank you guys so much for joining us today. We hope you learned something about Sandisk. I certainly learned something about this business. And this is just this is a mega trend that is causing so many companies to prosper right now. There's no doubt that Sandisk is in in a good position to have just explosive revenue growth and profit growth over the next couple of years. Yep. Well, thank you guys for joining us. We hope that you join us next week. We'll be diving into another stock from scratch, and check out the Stock Simplifier waitlist. We are going to be launching that in the next few weeks. The exact date is coming soon. We know you guys are absolutely, if you're the type of investor that likes to do this kind of fundamental analysis on businesses, we know you're going to absolutely love it once it comes out. With that, signing off. We'll see you guys next week. Brian's out.
Bye, everyone.